Intel coming out with this disappointing forecast. What are sort of the most important things to know about what it said and why it was disappointing?
Yeah, so the biggest issues were just supply constraints. They're saying that it wasn't necessarily that demand was below expectations. It's more so that demand from AI data centers for their more traditional computer chips, CPUs, central processing units, as customers look to upgrade from older servers, they didn't expect it to ramp up as quickly as it did and as much as it did. And what they said is going forward in the year, they expect supply constraints internally to be the most pronounced in the first quarter and then to improve throughout the year as they improve yields, which is just how many functional chips you can get from a single silicon wafer. They use their tools a little bit better and just work to improve output.
Now, foundry is kind of the biggest thing that investors now want to know about. So Intel has a couple of different businesses. When we say they make chips, they design chips effectively. But then they also have this foundry business, which is them actually making the chips. That's the thing the prior CEO bet on. That's the thing Lip-Bu-Tan is now trying to build out. And investors are waiting for more information on customers and who those customers are going to be. And we didn't get that yet, right?
Yeah, no. I think there's been a lot of hype leading up to the report. The stock was up like 46% leading up to the Q4 results. Analysts really didn't expect that they would announce a specific customer. There's been a lot of rumors that Apple will use their upcoming process, 18AP, which is just a more advanced version of the process they unveiled earlier this year, 18A. And also that Apple could use 14A, which is their upcoming process. 18A was initially supposed to be for outside customers, and they ended up just using it internally to make Panther Lake. And I think there was a lot of speculation that they wouldn't end up executing on an internal product with 18A. So customers had really held off. But now that Panther Lake has come out and has been successful, it's a PC AI chip. I think that's boosting optimism that they could get an external customer. And then also really what they need to do next is show that they can unveil a data center chip, Clearwater Forest, which is supposed to come out this year on 18A. So then, really to get to your question, they said 14A should have significant customer announcements potentially end of this year, early next year. But then, analysts noted that would mean that they wouldn't necessarily be ramping up production on that process until 2028, 2029. And one thing their CEO said is that they're not going to ramp up CapEx until they really know that they have a significant customer contract.
You gotta love the names of these things: Clearwater Forest,
I know,
Panther Lake, very zen. NVIDIA goes with naming them after people. They go with sort of natural names, which is interesting. Finally, I quickly want to ask about the memory chip situation, because as we know, there has been a spike in prices because there has been a lot of demand for memory chips, particularly memory chips tied to AI. How is that affecting Intel, if at all?
Yeah, so they didn't address it quite as much as I expected to in their earnings call, but their CFO did say that the memory shortage could, meaningfully affect their revenue this year. And the issue is more so that memory could affect the end demand for products that include Intel's chips. So, PCs and data center servers that have, that use a lot of memory alongside Intel chips, the prices for those products could go up, and then that could therefore affect Intel's bottom line as well.
Gotcha. All right, well, we'll be watching all of this very closely. We're going to talk much more about Intel throughout the show. Thanks, Laura.
Thanks.
Appreciate it. Kevin, great to see you. Let's start with Intel here, because I'm curious. I would love to try and extrapolate Intel out to the rest of the industry, but it is has so many of its own specific issues, challenges, maybe opportunities. So I'm curious, as an investor, is it something that you're looking at, that you own? And if so, what did this report tell you?
Yes, we do own Intel in certain of our Smart Trust UIT strategies. And let's dive into that earnings report that you guys just covered. Let's start with the good. Just in terms of earnings, 15 cents versus 8 cents expected. That's about an 88% beat. That's certainly good. Revenue exceeding expectations. Now, they did disappoint on their guidance, but it's the reason that they disappointed, Jules, that I find somewhat encouraging, because they didn't have the supply to keep up with seasonal demand. Now, if they address those supply constraints and boost their manufacturing, remember all the three big entities that invested into Intel in 2025 gives them the capital to expend in those areas. This could work out well for Intel in the long run. However, they're playing a big role right now in trying to nudge into the foundry business. As we know, their biggest competitor in that regard is Taiwan Semiconductor. Taiwan Semiconductor, the largest dedicated chip foundry in the world, with about a 60% market share that boasts NVIDIA as their largest client. So will Intel start to chip away and announce that one big anchor client as it relates to their foundry business, or do they lean more into their chip business, which has always supported and been what Intel is known for? They're taking a risk and a gamble with that foundry business, but we need more competition out there, and if they have the balance sheet to support it, this type of pullback could create an attractive entry point. But of course, Jules, they're trading at about, I don't know, I'm looking at my screen right now, about 82 times forward earnings.
Yeah.
So they're still trading a bit rich.
Gotcha. So maybe you don't want to step in quite yet until we get more information, perhaps on that foundry business. Okay, so let's kind of zoom out then and talk about tech more broadly. We saw this sell-off happen this week. Tech has not done well thus far this year, right? And there has been, continued questions, even expanding questions about the AI trade. What's your current thinking there?
Yeah, my view is that we're still in batting practice of a doubleheader as it relates to the AI revolution, Jules. And batting practice involves all the additional infrastructure investment that we anticipate taking place, not only in 2026, but for the balance of this decade. Remember that NVIDIA CEO, Jensen Huang, forecasted somewhere between $3 to $4 trillion spent on AI infrastructure investment. So the technology sector, those software and some of those hardware plays, I believe will be more volatile in 2026, especially those trading at heightened valuations. But more of the infrastructure plays, the data centers, the cooling solutions, the power solutions, that's where all the money's going to continue to be spent. And that's where I believe there's still growth opportunities as it relates to the AI trade.
And then something else this week, obviously, that we saw was the big sell-off, right, that was prompted by President Trump's Greenland threats and then sort of the bounce off of that. There was an interesting rift this week between retail and institutional in reaction to that sell-off. According to Bank of America, which cites fund flow data tracked by EFPR, we saw institutions, kind of sell on what was going on, but retail investors stepped in. And I'm curious about that rift and whether, buy the dip on Trump headlines, has that consistently been a good strategy, and is that something that people should be doing?
Yes, tariff tantrum round two, if you will, albeit much shorter lived in 2026 than it was in 2025. And I hope what I could glean from your statistics there is that retail learned a very valuable lesson from 2025. If we recall during tariff tantrum round one, the S&P 500 was down about 15% through April 8th of last year. Now, had retail investors at that point in time fled the market and rushed to the sidelines because of that volatility, boy, did they miss out on a significant rebound as the S&P 500 rallied, about 39% from April 8th through the end of the year. So trying to time the market, as we always talk about, Jules, is an exercise in futility. What's more important is your time in the market, provided that you're invested with the diversification that meets your risk tolerance. So it seems as though, at least in this short period of time, that maybe retail learned their lesson from last year as it relates to tariffs, but institutional traders perhaps were looking behind those announced and threatened tariffs and maybe a little deeper in terms of other potential bouts of volatility this year, which I think are coming.
Yeah, well, okay, let's talk about those bouts of volatility then, because you, in your latest note, you give a lot of different candidates for triggering that volatility.
And
I
we'll
guess
start with.
Yeah.
Go ahead, Jules.
Well, I was just going to say, I guess the question is, do you just stay in the market no matter what?
I don't know if it's no matter what, right? Because you really have to be honest with yourselves about what your true risk tolerance is. In other words, if the market is moving higher, that doesn't necessarily mean that your risk tolerance should move higher, just as much as if it's moving lower, your risk tolerance shouldn't move lower. You should stay true to your risk tolerance, your investment timeframes, and what your growth and income objectives are. But with that said, think about what could cause more volatility this year. We know that the continuing resolution that was passed at the end of last year to fund the federal government expires at the end of this month. In all likelihood, in my opinion, the federal government may and will shut down again. How long will this next shutdown last? And then we have midterm elections coming up at the midpoint this year. We're going to have a new chair of the Federal Reserve coming in May. What's the outlook for interest rates at that point in time? What about the debt ceiling debate? What about the unknown nature, Jules, of the current tariffs that are in place, the Supreme Court ruling, and what may happen to the tariffs that have already been collected? A lot of question marks. But if we continue to get earnings growth, if short-term rates continue to move lower, if inflation continues to moderate, and if we get all of this CapEx spend continuing to take place, whether it's with respect to AI infrastructure, aerospace and defense, or even healthcare, I think those areas of the market continue to move higher and overcome those reasons for volatility.
Man, I'm exhausted just listening to you list all of those uncertainties.
Think about me. Think about what's going on
I can only
head.
imagine. I can only imagine. Kevin, great to see you. Have a good weekend.
You as well.
Guys, thanks for being here. So we see these Intel shares pulling back today. As we look at that reaction, I'm curious what you think was revealed that was new in these numbers that is accounting for that disappointment, given that we've gotten some guidance around what Intel was expecting. Cody, I'll start with you.
It really was just the disappointment in their supply availability. They really realized the strength of demand of the server side much too late in 25 to start wafers earlier. They didn't start them until Q3 and Q4, so that availability of new product won't be available for them until the end of Q1, which accounts for their disappointment for the first quarter's outlook. But I do think that that sets the trough for the year, and then they, as supply improves, they are able to better meet that demand as the year progresses.
Matt, what do you think here? Because, you know, in the October call, Intel had sort of signaled this. Was it just that, but the stock has been running up, obviously, into these numbers. So what do you think around the messaging versus the stock action here?
Yeah, I think that it wasn't a messaging problem. I think rather that investors had gotten really hopeful that you start to see 18A ramp and there would be some pretty immediate benefits in terms of revenues and gross margins, particularly given a backdrop where, again, you're seeing constraints, you're seeing pricing rise. Those things typically lead to, higher gross margins, not historic lows. And so I think the stock just got ahead of where management's message was.
Now, guys, obviously the supply chain is an issue, but I guess the question is, should they have managed for it better? Now, your peer over at Bernstein, Stacy Rasgon, seems to think so. He wrote in a note in reaction to the numbers, he says, yes, the server cycle seems real, but the company appears to have woefully misjudged it with their capacity footprint caught massively off guard. Cody, do you think that Intel should have done a better job?
I think they should have. I think that that's a fair argument, that they said that their customers misforecast their own unit volumes heavily through the second half, and that accounted for their shortfall. But given the strength that we've seen through AI throughout 25 and what we've heard from NVIDIA and AMD, I think that the messaging was clear that demand was going to be strong. Intel was basically estimating based on their customer outlooks, and that at least accounts for the shortfall. But I think they could have managed it better.
What do you think, Matt? And do you have confidence that they are going to address this and manage it better going forward?
There was a step function change in August, September that no one saw. So you missed it on the memory side, missed it on the compute side. So I don't blame them per se for not understanding where demand was going to be. I think that the struggle on my end is simply how do we model all their new products, their new processes, and it's not clear to me what the change from here is, for instance, in terms of gross margins and how they return to historic levels of profitability, and that's the difficult piece for me.
Cody, by the same token, you are actually a little bit more optimistic on the stock, at least judging by your price target increase there. So what's your reasoning behind that?
Julia, I think it's a matter of the rate of change from here, that once you set a trough for Q1, that as they accelerate through the rest of the year and availability improves, that they get the benefit of their first shipments of 18A and the volumes and the pricing benefit, the margin benefit that new advanced process will hit their model as the year progresses. I expect they also, as the year goes on, they also are able to finally talk about new customers for their 14A program, and that will be the big catalyst for the stock, is if they can finally set a base for an ongoing foundry business.
I mean, all of this said, Cody, the stock run up, I mean, I guess you could argue some of it is optimism in what you're talking about, but a lot of it also had to do with, the president saying he met with Lip-Bhutan, the sort of external investment from SoftBank and others in Intel. And so when you look at the valuation here, given that it was sort of puffed up by some of those elements, how do you strip that out from where it should be valued here?
I think that there is that there's been a lot of hype and over exaggeration of maybe the momentum in the short term that obviously accelerated the stock. But I think in the long run, Intel is very well positioned to become a domestic alternative to TSMC and to be a real foundry alternative to an industry that's quite frankly extremely capacity constrained and in need of an Intel alternative. AMD has been killing Intel on market share. If Intel's new process is able to improve its competitiveness, then it may be able to stabilize its market share. And I think all of that, along with the domestic investments that we've seen from the government, from NVIDIA, from SoftBank, are all signals that are showing some improved confidence of Intel's competitiveness going forward.
Cody, I'm curious about the memory chip. I know you don't cover memory chip makers specifically. Matt, we're going to get to you on that in a second. But I am curious about the ripple effects for Intel. And we talked about this earlier today with our reporter, Laura Bratton. The idea being that if memory is in such short supply that, for example, PC makers won't be able to make as many because of that could then affect the Intel chips that go into those devices as well. Are you worried about that at all?
Yeah, and Intel communicated that as much last night, saying that higher memory prices and limited availability would likely limit their ability to fully capitalize on demand for the PC market, and that unit volumes would be impacted by rising prices at the consumer level. And so I'm not expecting the client side of their business to do much this year. I expect the server demand to be what really bails them out of this doldrums from the first quarter.
And Matt, you do cover some of the memory makers. I want to ask you about SanDisk in particular. That company's reporting soon. The stock is the best performer in the S&P this year, at least coming into today's session. But it does have very high short interest. I was looking at some data from S3 Partners that showed maybe some of this upside has been a short squeeze. You're a bull on the stock. So what's the fundamental case here for something like SanDisk?
I think the fundamental case, Julie, is that, again, you go back to middle of 2025 and memory vendors just had no idea this demand was going to show up with the memory industry. The problem is always that too much supply comes on and you end up with overcapacity. But because no one was anticipating this shift in demand, there simply isn't clean room space. So to build a new facility, it's a 2-year, 3-year process. Half of the industry also supports DRAM, and they're focused first on getting enough DRAM out there, so not building NAND capacity. And so it just looks like we've got multi-year positive cycle for the NAND vendors, which we haven't seen historically.
And if it is that multi-year cycle, whether you're looking at SanDisk or a Micron or some of the other, Western Digital, for example, that it had such a big year last year, so that implies you think that that can still keep going this year.
Yes, I think there's limited possibility that we get demand meeting or supply meeting demand this year. I mean, the one lone exception being some huge unforeseen demand shock, but from a supply perspective, you have the same problem in hard drives that you do in NAND, which is to build a new fab. In this case, for hard drive heads, it's a 2 to 3 year process.
We'll keep watching those stocks. Thanks, guys. Cody, Matt, appreciate it.
Thank you.